Hello, everybody. Welcome to another installment of our Southern California housing market updates. My name is Stephen Meade with Domicile real estate for people who absolutely love houses. And, kind of an interesting time. I think we have some changes in the air, and they are fundamentally altering some of our market dynamics. And we're really at a bit of a crossroad where we can kind of go in one of two directions, and we don't know what direction it's going to go yet. So before we launch into the numbers, I'm just going to kind of lay out the playing field for you. The first thing, right, that we need to talk about is inflation. And I think, maybe over a year ago, I was talking about that there was kind of an inflation other shoe ready to fall for a lot of reasons. And it looks like that shoe is falling. I think we felt like that was the case for a while, and now we have the numbers to back it up. I mean, when we look at our year-over-year CPI, the numbers that just came out this past week, we are at 7%, which historically is not the end of the world, but given more recent history, that's over double the kind of inflation numbers that we've seen. And the reason why that's a huge market dynamic is because if wages are following that, generally speaking, they do. In fact, I would argue that wages might have even in some wage categories exceeded that. That allows people to make higher payments on houses. This is a big indication of how much payment growth is too much growth, right? If inflation's 20% and home payments only went up 10% in a given year, houses actually got cheaper in real dollars. So that's a really important metric to understand. Another dynamic effect that we have going on in our market is interest rates. They are moving. The market is incredibly active. There have also been some changes from Fannie and Freddie that make loans more expensive, especially high balance conforming loans, which are the types that most of you out here are using in Southern California. So we kind of have a lot of forces that are pushing up and pushing down, and we don't know how those are going to reconcile just yet. So let's go through the stats. I'm kind of curious to walk through these with you, and let's get started. So total listings, right? We want to talk about overall inventory in the market. The good news is inventory has stopped dropping. The bad news is it's kind of leveling out a little bit. And normally this is a time of year when it's not leveling out. Inventory is going up, and we had a pretty level week, little bit of an incline down here in our 1 to 2 million category. But kind of even bigger to note is where are we versus a year ago? We were 5,500 houses, about under $1 million active. Right now, 3,500 houses. That is a big decline. And that lack of inventory does a lot to sort of prop up, to kind of prop up prices. It means even if demand falls, relative demand isn't falling. Another thing here is even down here in our 1 to 2 million category where things look a little bit better. I mean, we are still well below where we were a year ago. So it's kind of interesting to look at this and to see it's really too early to tell. So new listings in the last 14 days. Well, here is some good news, right? Look at the new listings coming up. We are blowing past our pre-Christmas levels here, trying to kind of get back maybe to some of those pre-Thanksgiving levels, but definitely not in our summer, spring levels. But gosh, that's a pretty remarkable jump. We did have a similar jump last year. The question is, where is this jump going to stop? And we still need a couple more weeks before we figure that out, I think, both under $1 million and over $1 million. So too early to tell. Are we going to see listings go up, or are the listings going to be less than they were last year at that rate of new homes coming on the market? Now we look at our new escrows coming on the market. What's interesting is we are almost exactly where we were last year on our 1 to 2 million, so our luxury market, but our under 1 million market is actually not where we were last year in terms of the number of homes going into escrow. So, is this a result of we just don't have enough inventory and the buyers are all there, they just can't find anything to buy? Or is it a result of interest rates dampening that buyer demand? And that's the question that we need to answer to figure that out. So one of the things you're going to hear me talk about more is this notion that we have I don't know if any of you remember this from high school physics class. You used to draw these little force diagrams, right? Like, so you'd have like the little box on the pavement and you'd diagram what direction all the forces were going. Well, that's kind of how the real estate market works a little bit too. We have forces that push prices up, that push demand up, and we have forces that push prices down and bring demand down. We have forces to bring supply up and push supply down. And our job is we try to look at these effects because it's almost rarely just one effect. You know, when you've got nothing going on except one thing pushing prices up, well, prices are going to go up, right? It's trying to reconcile the magnitude of some of these changes and see, you know, do we think that's going to result in a net positive of demand, a net negative of demand, same with supply, and then ultimately trying to reconcile where we think those prices are going. So, you know, we've got a lot of mixed signaling in the market, and we don't know how it's going to reconcile out just quite yet. So if we look at our absorption rate, this is another one where, you know, we're actually pretty close to where we were at this exact point last year, maybe a little bit softer on our 1 to 2 million. But these have clearly rebounded, right? This holiday time period, we see a lot of kind of crazy fluctuations. And I told you those are kind of artifacting in the data as a result of the holiday weeks, right? And the timing. These have kind of rebounded. You know, we're not seeing drastically low absorption rates, right? Where we see, you know, a bunch of houses come on the market, none of them go under contract. We're starting to see these absorption rates rebound. And I just realized I have a typo on this. Can you believe that? I have not noticed that until now. All right, closed prices. Again, this is looking backwards 4 to 6 weeks. So understand this is a snapshot of where the market was. Upper end of the market, prices went up, kind of heading towards new highs, maybe a little bit here. Definitely in this area of rising prices in this middle segment of the market, even though it dropped slightly. And then that entry level was pretty flat. This one, I think, maybe tells us a little bit more about our actual level of competitiveness in the marketplace right now. So if you're looking at this, this is of all the homes that came on the market in the last 2 weeks, how many are still available to buy? And so when this number drops, that generally means a more competitive market. And you can see that, right? If we go back to 2021, you looked at the spring numbers, they dropped and they kind of drooped down. And then through the summer, they slowly raised up a little bit. And then we went into the fall, things got more competitive again as inventory started to dry up. And we see that the same thing really true in our under 1 million, the blue line, and our 1 to 2 million indicated by the red line. But let's look at where these are right now compared to this point last year. So we're right about 70% for 1 to 2 million. Where were we? Oh, a little bit higher last year. So this says our market's slightly more competitive. And then where are we on our under 1 million? We're right about 66% maybe. Where were we there? 64%. We're actually very close to where we were last year when we took down these metrics. So this is a little bit of a mixed signal. We're not really sure, right? Absorption rate is maybe a little bit softer, but we're pretty close to the same. And this is also pretty close to the same as last year. Now, we have something else going on, right? And again, this is based on 4 to 6 weeks ago data because it's based on closings, right? Closings occur 4 to 6 weeks after contracts are negotiated. But look at this close to list ratio. Where were we at this point last year? Gosh, for under 1 million, we were close to 100% of list price, still a very strong market. And we were right at 100% for our 1 to 2 million. Look at where we are now, over 102% for under 1 million, and gosh, over 103% for our 1 to 2 million. So definitely a lot more sort of that disparity between where buyers and sellers are in the marketplace, and a market that's almost getting used to paying over list price. You know, just as an aside, I think I've talked to this before. You know, up in the Bay Area in San Francisco, it's actually very common for people to pay over list price for houses. And in fact, homes are essentially intentionally underpriced on the market, and with the understanding that buyers expect to pay over list price. It's kind of a little bit of a funky thing, but that's kind of that risk, right? When a market exists in a place for so long where people are paying over list price, it almost becomes like a custom of the market, right? And people almost do it by default. So, you know, my question is, are we starting, is this evidence of a market that is remaining super strong with that disparity between buyers and sellers' perception of pricing? Or is this a market that is getting used to 102-ish% over list price? And that's just on average what people expect to pay. And that we were going to have to see where demand goes to know. And then also we have here our days on market for new contracts. And you'll notice it started to creep up, and then boy, it is diving right back down here under 30 days. We are actually stronger than we were, right about the same this point last year. What this tells me is that buyers are in fact snapping up these new listings, and the listings that were on the market were the old crummy listings that people didn't want. And now that there's sort of fresh meat in the water, the sharks are circling and they're buying up the houses. They're starting to absorb that inventory, which is why we're seeing that level of inventory not really go up. Now, the affordability graph. Let's talk about the affordability graph for a second. Interest rates are rising, and I've got a graph for that we're going to see in a second, but we have crossed over that 120% threshold. Now, let's remember, what are we looking at? This is looking at the payment on a median priced home using prevailing interest rates in June of 2018. We are approaching, right? We are 3.5, approaching 4 years from that point. And in that period of time, the payment on a new home has gone up, or the payment on a median priced home is now about 20%-ish higher than it was in June of 2018. But we are also talking about a world where our CPI number is 7% in the last year. That means that maybe affordability might not be deteriorating quite as much as it looks like from this graph. I still am a little concerned with the speed of these rises. What works really well is when you see gradual increases over time, and I don't like how fast interest rates are moving at the moment. Speaking of which, here is the graph. And this is really the area that we are talking about right here. And I think it's important. In fact, you know what? We're gonna circle this. That's how important this is. It's getting circled. Look at the slope on this. I'm afraid if this keeps bumping like this, if we end up here in a few weeks, that's a very fast change to the market. And I think markets are generally speaking much better at absorbing slower changes. So I've always talked about it's not where interest rates go, or it's not just where interest rates go, but it's how fast do they get there. And I don't like the speed that this is moving. And what I'm wondering is, how is that going to interact with our incredibly low inventory? Is that low inventory enough to sort of basically say buyers are just going to have to suck it up and pay it? So when we're talking about that fork in the road, right, the question is, are we going to see a market that is softer in the next 60 days due primarily to interest rates? Or are we going to see some compounding effects in play that maybe make the market stagnate? And if you're a buyer, or if you're a buyer and a seller trying to move up, right, that's kind of a tricky scenario for you, because if that happens, if things go down, if the market softens, it's not really a net positive for you. It basically cancels out. If the market stagnates, though, it's actually worse for you. And the reason it's worse for you is because it means the market is still competitive. You get the same amount for your house, but your payment on your new house has now gone up, right? So if you're kind of one of those buy-sell people, I wouldn't be in the wait mode right now. I think now is the time you really need to do something. We still have very low inventory. Your home will get the views. And you're also hedging against possibly future interest rate rises that could be very detrimental to your buying power. Now, if you have a ton of equity in your house and you're only getting a small mortgage on the next one, this matters a lot less to you. But if you're somebody maybe who says, well, I have just about 20% down for my next more expensive house, this could definitely alter those economics for you in a not good way. So just something to bear in mind and remember. Thank you guys so much for watching. Do not forget to like, subscribe, and smash that notification bell so you find out when we have new videos that come out. Questions and comments, we always love those. And if you are looking to buy or sell real estate in Southern California and you like representation with expertise, definitely hit us up. We would be glad to help. We'll talk to you again real soon.